Hello and welcome back to The Note. Well, overnight we heard from Janet Yellen for the first time as chair of the Fed, and she seems to have had really quite a dramatic effect. The dollar is up across the board, and so are yields on US Treasuries, particularly on the 2-year. That's because she has been more hawkish than people had expected, and some are even alleging that she has misspoken or been too confusing. Always a cause of great anger when the Fed confuses the market. Are people being a little unfair, and what is the prospect for the dollar over the next few months? With me now to discuss this is the Chief Foreign Exchange Strategist for Rabobank, Jane Foley. Jane, thanks very much for joining me once more. We had a very dramatic rise overnight. Let's put that into context there. The dollar is still distinctly on the weak side. It's been much stronger than this on various occasions since the crisis. What do you think drove particularly what Janet Yellen had to say drove the market?
Well, of course, she did make that comment that there could be just 6 months between the end of tapering and the start of the Fed's interest rates hiking cycle. But of course, I think there's a possibility that she perhaps didn't mean to be quite so specific, and there's certainly a risk that there could be some pushback from Fed officials about that concern, because there was certainly sufficient rhetoric to say that there's no real change from the last FOMC. But then again, there's also a very slight tweaking in the views of FOMC officials, and you certainly can say a very slight movement towards a more hawkish stance from the Fed.
Yeah, what she was trying to do, I think, was move the needle very gently. The other thing that intrigued me was that the statement was the longest in many years. I mean, there was an attempt to really have an intelligent dialogue with the market.
Indeed, but then of course the market doesn't necessarily look through all of those extra paragraphs, and it looks at just one word, which was, I think, that 6 months time frame, which is perhaps a little bit harsh. I think perhaps, as you say, she meant a little bit of a gentle change. Instead, what she caused was quite a harsh movement in market expectations. Okay,
now let's take a look a bit more thoroughly at the fundamentals for the dollar. This is the Fed meeting came just after really quite startlingly good current account deficit news. The US now has its lowest current account deficit since the 90s.
That's right.
How does that play into the equation for the dollar?
Well, perhaps in a much more longer term way than just 1 month's worth of FOMC meetings, because what we see in this chart is quite a significant improvement in the US current account. As you say, we've got the lowest deficit since 1999 as a ratio of GDP, at the lowest ratio since 1997. Now, there's a couple of factors, a couple of themes here, but one theme is, of course, the shale gas revolution. Right. The fact that the US are importing less petroleum, that they're going to be switching a lot more to natural gas, and there are expectations that perhaps the US will be energy efficient 2035 or so forth. And this has implications for the balance of payments, implications for investment, manufacturing, and therefore the dollar. So in my mind, this improvement in the current account, along with the shale gas revolution, is a long-term dollar bullish factor.
Okay, and it really does look like a permanent shift or improvement in the terms of trade. Now, obviously, a big part of why the dollar is as weak as it is at the moment is because of the policies of the ECB over on this side of the Atlantic. If the dollar strengthens gently over the next few months, which seems to be the general suggestion you're making, if the markets get used to the idea of tightening from the Fed, does that help out the ECB?
It certainly would, because of course in Europe we have disinflation. Now, disinflation is a theme across North America and across Europe, but it's certainly quite problematic to the ECB. Talk of deflation, although ECB President Draghi is still denying that, but certainly the longer the euro is stronger, the greater the deflationary risk, because of course imported prices are pressed lower. So surely a lower euro dollar would help to try and boost price pressures in Europe and take the ECB off the hook. So a stronger dollar would certainly be very welcome in Europe, certainly very welcome in Japan too.
Okay, my final question, what if it turns out that the data we've had for the last few months is real data, that's really what we've got, it's not because of the bad weather in the US, we really have rather a sluggish US. Well, that's bad for the euro, presumably.
Certainly, that would be a big disappointment. If we had confirmation that the US recovery was indeed stalling, then we do have a lot of downward revisions for a lot of forecasters for the US dollar. Bearing in mind, there's a lot of US bulls out there. The market is anticipating that the dollar would rally this year, and it has been disappointed. So that would certainly lead to an upward revision in euro dollar, and that could lead and press the ECB into taking more policy action.
Okay, Jane, thank you very much indeed.
Thank you.
In conclusion, I think everybody needs to hope for and expect that the dollar rises a little more from here. It may have caused a bit of a shock last night, but broadly speaking, a rising dollar is healthy for lots of people.